In this video, I'll wrap up the week with some final thoughts around the forecasting exercise that we did. The knowledge check exercise had you create a forecast under a slightly different set of assumptions, really a much more optimistic assumption about sales growth. So in our high growth forecast, we were assuming sales growth of 20% versus 8%, and then made a few adjustments to some of the other items, really just to illustrate and show you how these line items can be forecasted at different amounts based on different assumptions, but these were the assumptions that we used. And it's interesting to compare what the financial statements look like under the base case and the high growth scenarios, in particular, how much new cash is going to be required to fund each of these forecasts. So first, we want to look at the income statement and see what our income profitability looks like under the various scenarios. And as you would expect, with higher sales growth, you're going to get higher revenues, higher expenses, because most of the expenses are linked to the sales rate, and higher net income. But it's always good to check and make sure you get the net income you're thinking you should get with the higher sales growth assumptions. And here we see under both scenarios an increase in total assets. Now, on the base case, it's a very kind of small increase in total assets going from 2000 to 2020. Under the high growth, it's a much higher increase in total assets, and we can see that's driven in large part by an increase in property, plant, and equipment. So we assume that more purchases are needed of fixed assets, capital equipment to support the growth. And this is something you might want to analyze and see if you can do maybe without that much investment in property, plant, and equipment, or whether that's really essential to achieving the sales growth that you're trying to get under the high growth scenario. So one of the things you really want to focus on in any kind of forecast is whether you're going to have sufficient amounts of cash. And as we saw in both the base case and the high growth case, that our forecast requires more assets than we have liabilities and equity, meaning we're going to need more cash. We're either going to need to borrow the money or raise it through selling stock, in some way get more cash. And here we see that the high growth, we get nice sales and great income, but boy, we need a lot more cash than we need with the base case scenario. And so then you have to evaluate whether or not you really can get 292,000, or if it's a bigger company, 292 million. But as you can see, this is much higher, 6 or 7 times higher than the amount of cash you need in the base case scenario. So what you need to take away from this exercise and this module we did around forecasting is that there's different types of growth, and growth generally requires pretty significant amounts of cash. And so not all growth is going to be beneficial to the company. You've got to be able to afford the growth. You've got to be able to fund the growth. You've got to be able to have sufficient amounts of cash to finance the growth. And as you see here, good growth really requires a delicate balance among some of these key drivers: sales growth, operating margin, days in receivables, inventories and payables. All those factors have to be in balance so that you're going to have sufficient amounts of cash to fund your growth. And the whole purpose of the forecast is it helps you manage that balance. So with a good forecast, you can play around with the numbers a little bit. You can change these key variables: sales growth, your profit margins, your working capital ratios, to make sure you can come up with a forecast that you think you can actually fund, that you can have the cash for, and that it's achievable and will satisfy the needs and expectations of your investors. And that brings to a close our 4 weeks together, exploring the wonderful world of financial accounting and financial statements. We've looked at all facets of the financials, from preparation to analysis, and finally, this past week, to forecasting. And in the process, I hope you find yourself more comfortable with the terms and concepts and more confident in your ability to use this information and to have those conversations with the finance people in your organizations. And most of all, I hope we've been able to extinguish some of the fear you may have had coming into the course. Going forward, you're really now in a much better position to take some of those deeper dives into other areas of finance and financial statement analysis that may be of interest to you. So thanks for taking the course, and I wish you all the best in all of your future financial adventures.